If one of the two following scenarios exists, then it is necessary for the company to accrue for the termination benefit during the terms of employment, rather than the termination has been announced, rather than it makes termination or voluntary redundancy. Scenario 1 is the employer can reasonably estimate the number or percentage of employees it does not want to retain, and determine the level of such severance payment by reference to internal human resource policies, past experience or employee turnover rates, and applicable laws, or by other means that may result in a reasonable estimation. And the second scenario is employment contracts are due to expire upon completion of a certain job. If the practical case falls into any of the scenario, then it is necessary to accrue such termination benefits during the terms of employment as a normal cost of labor, And the last topic is presentation disclosure requirements under the PRC gap. Firstly, the set of financial statements. Under PRC gap, the form and the content of financial statements are uniform format prescribed by the MOF and issued every year, near the end of each year. The MOF will issue a notice announcing the exact content and formats of the financial statements to be filed, of companies to be filed with authorities. It will also put on the internet a special set of software. The companies need to input their financial statements in that software and submit in the soft copy over the internet or in the thumbnails to the government authorities. But under RFIs, only an illustrative presentation accompanies IS-1 for reference purposes, not mandatory. Under the PRC gap and RFIs, names of items, content and format of financial information, financial statements may differ under different gap. Thus, reclassification and reconciliation may be required, even if the number of net assets and net profits is the same under the IFRS and the PRC. The reclassification and reconciliation may still be required. For example, we all know that under IFRS, the sales amount is net of the goods and service tax. But on the PRC gap, the gross amount should be presented as sales. Then a special line item named as operating tax and surcharges is needed to make such deduction to get the net sales. Also, under IFRS, we have a line item as called other income, such as dividend income, interest income, disposal gain or losses of fixed assets, etc. But on the PRC gap, we does not have other income, the other income item. We can only have revenues and costs from other operations and financial expenses and other non-operating income and expenses, not just other income or other expense. A third example, dividend income and interest income is regarded as income, as a revenue under the IFRS, but Under PRC GAAP, it is presented in the special line item, investment income, together with gains and losses from the disposal of investments. That's to say, the dividends and interest income arising from investment activities are not regarded as revenue under the PRC GAAP, although the amount will be the same. Second is the cash flow statement. Under PRC GAAP, both direct and indirect methods are required for the operating activities section. Under IFRS, the company may choose either the direct method or indirect method. However, the indirect method is more commonly used. So you can see that the cash flow statement under PRC GAAP is more complex because both direct and indirect methods are required. Regarding the notes to financial statements, both IFRS and PRC GAAP prescribes basic disclosure requirements, but the specific disclosure requirements for any particular financial statements items and the level of details may differ. For PRC listed companies in Shanghai, listed on Shanghai and Shenzhen stock exchanges, they are also subject to special requirements issued by CSRC regarding the financial statement disclosures, which requires much more disclosures, information disclosures in the notes to financial statements for listed companies. We can just compare a company's annual report, which is listed on both Shanghai and Hong Kong stock exchanges, for example. The annual report on the A-share information disclosure requirement is much more thicker than the annual report for the same company for the same year, prepared under the Hong Kong listing rules. So the detailedness, the level of detail of information disclosure may be different. And the last point is the consolidated financial statements. We all know that under IAS 27, certain intermediate holding companies may be exempted from preparing consolidated financial statements, which is prescribed in the paragraph 10 of IAS 27. But under old PRC GAAP, most investment holding company vehicles established by overseas parent, generally known as China Holding Companies, or CHC, are also exempted from preparing consolidated financial statements. However, after the transition to the new PRC GAAP, such exemptions will no longer be available. Under the current